Carlson. He's free. He's in.
We got a whole new ball game, Matt.
"29-yard touchdown run. Ben Carlson, 21st touchdown of this, his junior season." And you...
Welcome to Ask the Compound, the show where you ask the questions. We provide the answers. On today's show, win rates for diversified portfolios over different time frames. Are we on the brink of a recession? A lot of people are asking this. Is there a case to be made for the Fed to actually hold rates higher for longer? A few people are asking this, not that many. Is it time to go all in the Nasdaq 100 as your index fund of choice for retirement savings? And how price action works when the stock market is closed, from the close of one day to the open of the next day. Remember, email here, askthecompoundshow@gmail.com. We always appreciate your questions. Our doc is just overflowing with good questions from people. Good stuff. Today's show is sponsored by Public. Public.com. You can earn 5.1% APY with a high-yield cash account, plus no fees, no minimums, because what's the point of earning a high yield? You have to spend a bunch of it on fees. Public.com, 5.1% APY straight up, no strings attached. No balance requirements, so you can deposit as little as you want. Public provides up to $5 million of FDIC insurance. It's 20 times the standard coverage. Pretty good deal. Go to public.com to learn more. This is a paid endorsement for Public Investing. 5.1% APY as of June 17th, 2024, and is subject to change. Full disclosures in the podcast description. Check out the link.
I'm wearing my Public hat. This is a Public hat.
Very nice. Not a bad deal. All right, let's get into it.
All right, everyone. Up first today, we have the following. There's a lot of data on the probability of positive S&P returns for different time periods. Does anyone have similar data for different portfolio allocations? 60-40 stocks, treasuries, etc.?
Great question. Right in my wheelhouse. This is the kind of thing that I like to look at. So, all right, John, throw up the first chart here. This is one of my all-time favorite charts of the stock market. As a staunch advocate for long-term investing, I like to use this one over and over again. It shows the S&P 500 back to the 1920s, how often it's positive over daily, monthly, 1, 3, 5, 10, 20-year periods. And the big takeaway here, of course, is that the longer you extend your time horizon, the more likely it is you're to see a positive outcome. It's actually closer to a coin flip than you would think in the daily basis, but go out 1 year, 5 years, 10 years, 20 years, there's never been a down period in the stock market. Caveats apply, obviously. These are nominal. This is nominal data, no fees, no taxes, all that good stuff. Still, the main point stands. The longer your time horizon, the better off you are investing in the stock market. I've actually never looked at this for diversified portfolios before. I've looked at a lot of data for diversified portfolios, but not in terms of the win rates. So had our chart guy Matt do this. John, throw it up there. This is the win rate for a 60-40 portfolio. This is U.S. only, S&P 500, and 5-year treasuries, which is just intermediate term bonds, basically. And you can see, pretty good here, right? The monthly period is basically the same as the stock market, 64% of the time, it's positive. But look at 1 year out, we're talking 81% of the time. 5 years out, we're looking at 95% of the time, 60-40 portfolio is positive. And then 10 years out, 100% of the time, positive results. John, chart off. That's pretty good. Negative, but never been a negative 10-year return for a 60-40 portfolio. The biggest pushback I typically get, as I mentioned in the caveats, well, what about inflation? And I think inflation makes more sense to look at when especially when you're thinking about fixed income, because that's your biggest risk for the bond side of the portfolio. So John, do our next chart for all the real return people. Here are the inflation-adjusted win rates over the same holding period for the same exact 60-40 portfolio. Still pretty good. 0 down periods over 20 years. Now we're closer to 90% positive win rate for 10 years. 5 years is still 84% of the time it's positive. 1 month shrinks to 60%. So knocks things down a little bit, but we're still in the same section of the same ballpark, right? So this data is pretty clear. The longer your time horizon, the more likely you are to experience positive results. Of course, the returns themselves are not promised or guaranteed, and they're going to end up all over the map. That's not saying you're going to get a specific return here, but your long-term odds of success go up the further out your time frame goes, which is harder than ever to do because we're so much more short-term oriented these days with the amount of information we have and paying attention 24/7 to this stuff and alerts and confetti and all this stuff when you trade. So it's probably never been harder to be a long-term investor, but that's where we stand.
Yeah, you'd be surprised to hear, but the less I do to my accounts, the better they seem to do.
Funny, right?
Yeah, funny how that works.
There's the study that someone mentioned that the people from Fidelity that were dead were the best performers, like they died or they lost their password, they were the best performers. That one's never been proven. It might be just this wives' tale, but it sounds right in theory to me. If you were to lose your password, you'd probably do better than most people by not trading.
Well, and I think most people think, you'll end up buying stocks that go down a lot or something like that. But in my experience, not to brag, but I end up selling things too early. So you know what I mean? So you miss out on massive gains that you would otherwise have if you hadn't sold. Yeah.
The long-term wins again. All right, next question.
All right, that first one was from Travis, by the way. Up next, we have a question from Michael. I like this one. Are we on the brink of a recession, or am I just overreacting?
You just like this one because it's so short and to the point.
Well, true, but
With
it's
the
also
two
it's
slides.
like the $1 million question right now.
All right, let's bring in some help on this one. You know her from her appearances on other compound shows such as The Compound and Friends, and what are your thoughts? Her first time on Ask the Compound, our new chief market strategist at Ritholtz Wealth, Callie Cox is here.
Hey
Callie.
guys, what's up?
Callie, you've been providing tons of research for everyone over the years. You've joined Ritholtz recently, and now we have a bunch of these Slack channels going. We're constantly looking at this stuff, and you're providing good data for us and for our clients. The guy who sent in this question also sent me his newsletter. He has a Substack, and he laid out the case that we've been talking about for a while. He's saying, listen, there's a cooling labor market, bear market and housing market activity, default rates are rising for corporate bonds, the IPO market has been dead for a while, government debt levels, inverted yield curve, all these things that we've been discussing for a while now. So his conclusion was, listen, it's time to cut rates, but I'm worried it might be too late. And that's why he asked, is a recession inevitable? So what do you think? Where are we in this cycle? Because my stance is it's impossible to tell between a normalizing economy from weird COVID stuff and a potential slowdown that could morph into a recession.
Yeah, I mean, is it bad if I agree with both of you? By the way, if it's Michael Batnick writing in this question, blink twice. I'm just kidding. Yeah, well, Michael, I agree with you to a point, and to a certain extent, when we talk about the economy these days, I feel like we're talking in a language of degrees almost. Are we on the brink of a recession? I don't know. Are we on the edge of a cliff when it comes to a recession? I don't know, but there are two things that I think the data shows us pretty clearly. The job market is slowing down. It has been for a year plus, and unemployment is climbing. And when I think about the economy, I like to focus on the job market first. Why? Because consumer spending is 70% of the US economy. And when people are making money, they're spending money. It's tough to boil down the economy into that, but I think over the past 2 years, what we've seen in economic conditions has really shown us that it's the job market, right? Everything else has frozen up. We're kind of just waiting on the job market to erode. If you're one of those people, expecting a recession.
I think that is the other people are expecting. Like, listen, once, yeah, sure, people have been spending their faces off the last couple of years. What happens when they start losing their jobs? Is this spending going to continue?
Yeah, and I would guess not for reasons I just mentioned. But I think the question is, how far can we push it? And I'm not saying I'm an advocate for pushing the economy here. I don't want a recession to happen. They're awful. And unemployment is moving higher. But I think the context really matters here. For example, one thing that we're seeing in unemployment is that the unemployment rate is rising because more people are entering the labor force. And that's a good thing. You want to see that happen in a strong or solid economy. The problem is the good can turn into bad pretty quickly, because if you're entering the labor force but you can't find a job, then that's kind of a damning statement on the job market and the fact that hiring isn't happening. But I classify it, Ben, as, the economy is in the danger zone, which I know is like another derivative of saying we're on the brink of recession. We're not there yet, but I find that it's really hard to tell when we are. And I'd have to see a pretty big deterioration in job market data for that to happen.
So what do you think, the unemployment rate creeping higher, are you worried that historically, every time that's happened, it keeps going higher? and it's hard to arrest that and stop it? Or do you think the Fed coming in and lowering rates can actually have an impact? So, John, pull up Callie's unemployment rate chart, right? You got that upturn. If I'm a technical analyst here, this is one of the biggest red flags you can see from someone if they're doing technical analysis on an economics chart.
Yeah,
but if
please
we
don't
are
do
here, we're the downtrend is over and we're turning back up here.
Is that a head and shoulders?
Yeah.
I can't
Two pretty
even
big shoulders.
I can't even entertain a technical analysis on this chart. But I mean, what you can see throughout history is that when the job market breaks down, it breaks down rather quickly. And this is a worrying thing. I mean, this is what the Fed is thinking about when it's determining when it's appropriate to cut rates. And you know what? A 25 basis point cut probably isn't going to do much for the job market or corporate America's plans for the future. It could, and we've seen this, but it could lower long-term rates to the point where we see some activity in the housing market. We see some activity spill over into manufacturing. But will it be a game changer?
Right, the Fed might have to
not.
signal it's not just 25 basis points in September. It's also going to be another 25 at the next one and 25 or 50 at the next. Like, they're going to have to throw corporations a bone here probably to say, don't worry, we're getting there. We have a target. It's going to take a while because they don't ever move swiftly unless it's a financial crisis situation, I suppose.
Yeah.
That might be what they're going to have to do to save the soft landing.
Yeah, and I want to throw one more chart up, John, the NFP chart, because today is actually a really timely day to be talking about this. We got, this is a little going down a nerdy road, but we got these annual benchmark revisions from the BLS today. Basically what the BLS does is they release the monthly jobs report, but
in economics, Twitter was going nuts over this stuff.
It was going nuts, yeah.
Right?
I mean, it really is like a nerdy caveat and footnote in the whole grand scheme of things. But, the BLS sometimes takes a step back and tries to, raise the fidelity of their data through double checking it against other data sources. And today happened to be the day where they rolled out the revised non-farm payrolls or job gains data for the 12 months going back from March of 2024. So a little stale in that way, but economics Twitter, like you said, Ben, was going nuts because they basically revised down the job growth that we saw in that period by about 68K jobs per year. And John, if you throw it back up, I want to make one quick point. So obviously that's not good. What you see here is the job gains that we saw over that period in relation to the total growth in the workforce, just to add some context there. And we were running a little above average when you compare it to the 2010s hiring pace we saw, but now we're running a little bit below average. But, there's a lot of chatter around this. I don't think it really changes the story that much, but it does add to that case of, being a little bit more worried about the job market and where we are.
All right, maybe the job market wasn't quite as strong as people thought in the previous months. But your point, and you said it doesn't change the unemployment rate. That is still the same, but it was, like you said, almost 70,000 jobs per month of that initial estimate. The funny thing about these economics data points, and we could go down a rabbit hole, is they get revised for years, right? Because at some point, so this happens, but worth pointing out. So maybe the Fed, let's get to our next question, Duncan, to talk about this, but it seems like the Fed
First I have
has no
a
other
little
choice.
follow-up for you guys. I don't want to completely derail the show, but I see so much arguing about what constitutes a recession. So for our young people, our new people here, what's the cliff notes of what a recession even is at this point? Like, how do you describe what a recession is?
Ben, can you cliff note this?
Because I know it used to be 2 consecutive quarters of
technically it was
GDP,
never it was technically
negative
never
GDP.
that. People thought it was, but the National Bureau of
I've read
Economic
that
Research,
online.
they have this list of things that they look at. And it's things that you would assume. It's consumer spending and it's job loss and it's all these different things that they have to look at. And half the time they tell you 6 months later. They don't tell you like, hey, we went in a recession today. It's here. The only time in history we've done that is during COVID. Everyone knew we were in a recession at the same time. So there are a lot of different aspects, and maybe that's a question for a future show, Duncan, of like going through those bullet points. But it's kind of the stuff that you think. And that's why when we had 2 negative quarters of GDP in 2022, when you're looking at the unemployment rate still falling, that was your tell there that, okay, this really isn't a recession. You don't go into a recession when people aren't losing their jobs. So that was the tell back then.
Yeah, it seems like something that should have a more defined, explanation. Everyone has their own version of what it is, which makes it super
I guess the
confusing
point
to
is the
people.
economy is it's so big and cumbersome and dynamic that it's hard to have a hard and fast rule for it.
Yeah.
Is that fair, Callie?
I mean, I think the closest you can get to is spiking unemployment. But one thing I'll add to 2022, because you're right, we did technically get 2 quarters of declining GDP. You have to remember GDP, of course, is this compilation of a bunch of different factors, but the world is being so affected by trade imbalances and by this like inventory guessing game that companies were going through. And those are 2 main components of GDP and how they're calculated. But I don't want to say that GDP was almost had like a COVID dysfunction to it, but there was a little bit of that going on. And all throughout, like seeing this GDP data go negative, we saw the unemployment rate continue to tick down and hiring was actually quite solid. So that's why people say, 2022 felt awful, but we don't think it was quite a recession, even though it fits that like high school textbook definition of recession.
Okay, cool. That's helpful.
Yeah, Duncan, quit using high school definitions. What do you think?
I didn't mean it like that. I didn't mean it like that. Your high school teachers did well by you, I promise.
All right, let's do the next one.
Up next, we got a question from Dave. Ben has been pounding the table for a few months now for a rate cut. As an econ professor, see that? We got professors watching. I like to see both sides of these arguments, so I'm curious to hear your devil's advocate on this. What's the case for the Fed keeping rates where they are? What if inflation comes roaring back?
Probably not many people making that case right now. I think the higher for longer people have fallen up to the wayside the last, 6 to 8 weeks. Matthew Klein at the Overshoot had a piece earlier this week, and he's a smart guy. I wasn't overly persuaded by his arguments, but he was kind of saying maybe the disinflation isn't as great as we think. I guess the one argument, Callie, you can tell me what you think. Lowering rates, housing activity picks up. There's no more disinflation in shelter, which is the biggest component of CPI. Maybe that could be the thing that, inflation ticks higher because we're increasing housing activity. My biggest question would just be, where does the wage growth come from? That's the part that I don't see turning back around all of a sudden again, and all of a sudden employees have the upper hand in wages. So what do you think? Is there any legitimate argument for the Fed staying higher? I don't think there is.
I don't think there is either. And for the reasons you mentioned, Ben, I mean, wages are 80 to 85% of business costs. So if you don't have that inflation spiral in wages, then it's really hard to, see that bear out in the rest of the economy. And I actually put a chart up, or I made a chart for today about, where we were with inflation and how far we've come. John, perfect. Yeah, and this is what I think about when I think about, where, what the Fed is considering in terms of policy and what to do next. I mean, we have come a long way since the peak of the inflation crisis in 2022. This is just a smattering of things that you have to pay for. Obviously, rent is in there, like you mentioned, Ben, gas prices as well, airplane tickets, which I know is a pain point for many of us who travel a lot. But we have seen inflation come back, and especially on the services side, the side of inflation that the Fed actually cares about. Rent falls into that bucket, medical bills fall into that bucket, vet bills, haircuts, the kind of prices or kind of spending that is affected by, people making more money, but also wage growth kind of running away from the Fed.
I've noticed it in places like hotels and airline tickets, and that's the kind of thing that if you do it enough, you notice like, hey, things seem to be getting better there. There's actually some deals out there, and there haven't been for a long time.
Yeah, so we've come a long way is my point, and policy is still really tight. I mean, I keep saying, perfect. John's like reading my mind over here. I keep saying on Twitter, at least, I keep talking about this phrase that Powell likes to say, the balance of risks. And when he mentions that phrase, he's talking about the Fed's dual mandate. And I probably should have started with this, Ben, but you have to go back to what the Fed is here to do, what they're obligated to do. They're here to promote maximum employment and stable prices. So the stable prices side, of course, that's inflation. That was way out of whack in 2022. And that's gotten a lot better over the past 2 years.
So your chart here is showing the spread of the Fed funds rate over inflation. And
right.
So we're well over 2% higher now. The Fed funds rate in the 5s and inflation now below 3%. That's a huge spread there. And I tend to agree that why does that spread have to be so wide? Time to
and that's what I'm
down.
trying to show. I mean, the Fed is being restrictive in policy. The Fed is hitting the brake on the economy right now. And considering what we were talking about a few minutes ago, the job market is slowing, unemployment is moving higher. Is it appropriate for the Fed to be super restrictive at this moment? I don't think so, given how the trends are moving.
Yeah, and even if they cut 100 basis points by the end of the year, whatever the market is pricing in, you're still in the 4s for short-term rates. It's not like they're going immediately down to 2% or something. it's those rates are still relatively high, and the bond market has already moved. So the Fed is kind of the last to go here.
Yeah, so I think it's a matter of neutral. How far does the Fed want to take its foot off the brake? I think you can make an argument for taking it fully off the brake, but not hitting the gas, if you want to make a car analogy.
Right, just get off the parking brake at least.
Get off the parking brake, yeah.
Yeah, take it off.
Also, for business and econ and investing professors out there, send me an email. I'll send you a bunch of stickers so you can help promote the compound to your classes.
There you
So
go.
we
You
get
know,
the next generation.
I had someone from the Yale School of Management reached out last week and said, "Hey, we want to use one of your blog posts for our courses this year."
Nice.
Look at you, Ben.
I know, Ivy Leagues, right?
Yeah.
Now you just need an honorary doctorate.
They would know. Yeah.
Dr.
All right.
Carlson.
Next question.
All right, up next we have a question from Sean. Would it be crazy to go all in on QQQ for my retirement accounts? Am I just not zooming out enough? The QQQ has outperformed over the past 20 years, but is this just a fluke of the times? Is the broader market a more reliable bet over the next 30 years?
Good question.
I have the same question, but for TQQQ. You know?
Yeah, which is the double or triple?
Triple.
Okay. So rarely, if ever, do you see investors asking, should they go all in on an underperforming asset class? Of course, the questions are, it's always basically, should I go all in on the best performer after it's had an amazing run? It's also kind of funny, too, how the Qs are kind of on par with SPY now in terms of they're part of the lexicon, right? That ticker is part of the lexicon. So I would never say the Nasdaq 100 shouldn't be a core holding. I think you can make a really good case that it could be a core holding because I think an allocation there is a good diversified exposure to the AI opportunity, should it exist as people say it will. But I would be hesitant to tell people go all in now after we've had 15 years of like 20% annual returns.
Yeah, this question made me think a lot, Ben. And, you know, I'm a thinker by trade. I mean, that's one of the reasons I'm an analyst. I think way too much. But when I saw this question, I was like, well, obviously the argument is, you know, you're super concentrated in tech and there are a lot of tech specific risks that you have to consider. Plus the data, the historical data shows that, you know, tech, as many imagine, is way more volatile than the overall index. Makes a lot of sense. But then I kind of hopped to the other side and I was like, you know what? In a retirement account, obviously you have to consider taxes. There's not much difference there, but you're also not checking it as much. So, you know, maybe there's an argument. And then the Qs are looking more like SPY every single day with big tech dominating.
Yeah, it's just a little more it's just more concentrated.
Yeah,
right?
It is more concentrated, but with every concentrated portfolio investment, you have to consider that you're taking on more risks for more return. And where I kind of fell out here, and John, I have a chart on Nasdaq sell-offs. Perfect. Okay. So, you know, the side that I came out on here is, you know, obviously there's more risk there, and, you know, hopefully you get more return for it. But do you really need, you know, strong yearly returns in your retirement portfolio if the advantage that you have in that kind of portfolio is time? I'm not so sure, especially when you consider the trade-off of, you know, seeing potentially 7 bear markets in the past 34 years, like we've seen in the Nasdaq 100. And by the way, over this period, the S&P went through 4 bear markets or drops of 20% or more. So tech stocks are definitely more volatile and they have more catalysts kind of affecting their ups and downs.
Yeah, but I do see the idea of tech's a bigger part of our lives now. It's a bigger part of the stock market than it's ever been. Why not? I don't like the idea of just going all in, but as a core holding, and you have other core holdings as well, and you're using it to rebalance in the retirement accounts, I don't see a problem there at all having the Nasdaq 100 be part of it.
Yeah,
just don't expect it to
there.
Just don't expect what it's done over the last 10 years to happen over the next 10, because so maybe the point is, if you're going to do this, dollar cost average in, because the whole going all in and taking everything out of all the other funds and going in on this, that could work. You never say never, especially if the AI opportunity is as big as people say it's going to be. But if you're going to leg into the position over time and these stocks are more volatile, that makes more sense to me.
Serious question. Back to Callie's chart. Back when the Nasdaq 100 was down 70%, what would happen to a triple levered Q ETF?
Oh man, it's so hard
I don't
to
know
because
how you do that math.
To a certain extent you can't, because funds have their own risks too. You don't know
95% probably. It would be down.
Sounds like a buying opportunity.
Yeah. But I'll also put my advisor cap on too. And I'm not an advisor, to be clear. But if you're thinking about financial planning, I mean, everybody talks about coming up with that number that's enough in your retirement. And I think it's a good exercise to just sit down and understand what you need to do to get to that number that you lay out there. Like if your number is 5 million, if that's more than enough for what you need in retirement, understand like how much return you need to make on your current money and on your investable money to get to that point, because chances are you're probably not going to have to take on that kind of risk.
All right, Duncan, I pulled it up for you. So in the 2022 bear market, when the Nasdaq was down 35% or something, TQQQ was down 82%. So if in a 70% massive crash, which I wouldn't predict, this thing is probably down 98% or something.
Wow.
Also, can you put levered ETFs in a retirement fund?
I guess in an IRA,
definitely.
and yeah, not like a...
Speaking from experience, yes.
Oh my God, Duncan!
I mean,
We're gonna
not my
Story time from
401k,
Duncan.
but an IRA.
We're going to have to do an intervention eventually. Duncan, one of these shows is just going to be a group of all of us intervening on...
I'm a case study. That's what
All
I
right,
am.
there you go. All right, we got one more question.
Okay, last but not least, we have a question from Jonathan. Longtime listener, love the content. I was curious if you could explain price action during non-trading hours. For example, the closing for an S&P index fund on Friday is not equal to the opening price on Monday. Is it institutional investors who are able to trade after hours that are moving the market? I'm not a trader, but it seems like the retail investor is kind of blocked from partaking when events occur outside of trading hours, like Japan's sell-off that influenced U.S. markets.
All right. I got a chart for this, John. Throw up a chart. Matt, our chart kid, did this. He showed that August 5th had the fourth largest single-day gap down since 1982. Now, gap down means the closing price on one day and the opening price on the next day. And he put these all in the chart here. You can see all of them have happened since 2020 beyond 1987. So things are moving faster overnight. And the way that I see it is this makes a lot of sense. Markets are more globalized. We have more information and it's traveling faster. And also, all the economic releases that Callie's been talking about here, that stuff happens outside of market hours.
Yeah.
The most economic data comes out at 8:15, 8:30 in the morning or something. The earnings
Eastern.
releases come after hours, right? They happen at 4:30. So the information that is moving markets happens before the open or after the close. And the fact that markets are more globalized than ever means that you see bigger moves. So I think this is just kind of the way it is. The question about should investors care that they can't take part in this is a different one. I'm fine having market hours the way they are. I don't know about you, Callie, but I can't imagine a world of 24/7 trading and being on all the time. But this whole gap up, gap down thing is just something that people have to get used to, I guess, right?
Yeah, and I think you have to be careful what you wish for too, because obviously it'd be great to be able to trade 24/7. That sounds like a nerd's dream, but there are things that have to happen on the back end to make that possible. And most investors probably aren't served well by having that kind of access to markets. And I say that as somebody who's a complete proponent of people being able to access markets and do whatever they want with their money. I mean, you have to think of this from a sanity perspective. And the fact that usually the first move in markets isn't the right move or isn't like the enduring long-term move. So, I mean, the other thing you could say is it kind of already exists. Some platforms have 24/7 trading, but...
Yep, Robinhood allows certain stocks to be traded after hours. You have to wonder about
Public has after-hours trading, too.
You have to wonder about the liquidity in some of those
Yep.
as well. If it's not happening, that and to your point, the amount of mistakes that could happen. Think about the night Trump got elected in 2016 and markets were down 7% overnight. I remember thinking, I'm buying stocks tomorrow, hand over fist. And by the time the market opened, it had basically round tripped and I think finished the day up or just down a little bit. And so, yeah, I don't think that you're totally missing out here by not being able to trade more. I mentioned this before, but stock markets in the U.S. used to be open on Saturdays for a half day, which must have just been brutal after a whole week, and then you have to go back in. And so I think the big gap up, gap down. Some people look at the, I've seen, I think there was an ETF started on this, right?
Yeah, that sounds right. Yeah.
Right.
I can't remember how exactly it works, whether it was
but-
going to sell at the close and buy at the open or vice versa.
I think it was buying the close and selling the open, something like that.
I mean, I'm a big proponent of simplicity when it comes to investing. I don't think that there's a lot of economic rationale there for for that strategy, but seeing these big gap up and gap down, it makes sense with the way that things have changed and technology has progressed and the free flow of information. Things just used to happen so much slower in the markets back in the day, and now everything is instantaneous.
Make sure you're using limit orders if you're trading them after hours. I just have to throw that out there. I've seen stocks up like 15% just because there's no action on that stock, and so someone just placed like a crazy ask, and so it'll get fulfilled at something very unfavorable if you're not careful.
Put limit orders on your TQQQ, Duncan.
There you go. Yeah.
All right.
Yeah, I'll just echo that too. Just because you have access to trading a market doesn't mean that it's a good market to trade, for reasons of liquidity, for reasons of pricing, and that those types of factors are ones that you can't change with access, right? Like if everybody had access to 24/7 trading, volume would probably be higher in the nighttime hours. If something happened overseas, like a yen carry trade imploding. Does that sound familiar? But it doesn't mean that there's going to be enough people trading it that you're going to get the fills you want and the prices you want. And, again, it doesn't mean that the market's first move is going to be its, move for the day. And my gosh, wouldn't you rather be sleeping?
Right. And we've
Sometimes
seen plenty
I'm think of your sanity.
And it's not just the down gaps either. We've had up gaps as well, right? Where it happens the opposite direction where stocks are up. And so, yeah, I think the increased temptation to make a change when you probably shouldn't more than outweighs the benefits you'd get from trying to nail the bottom or top in something.
Yeah. One more thing I'll say is that I was looking at the gap opens, kind of like Matt was doing, and guess the day where there's been the highest average gap opening. Day of the week.
Like day of the week? Is it just Monday?
No! I thought it was going to be Monday, but it's actually Tuesday.
Okay, turnaround Tuesday. I don't know why that would be, but okay. Makes sense.
We got to figure out a way to trade that.
Okay.
I know. Create a fund or something.
Tactical model.
My brother used to always ask me, like, isn't there a way to somehow game the 401k purchases since they probably happen on a Friday when people get paid? And, I think the market's a little smarter than that. That'd be my only way of thinking. That those kind of simple rules sound really intelligent until you actually try them.
All I know is whenever I have a call expiring on a Friday, that stock is down that Friday. So that's something I've got to harness at some point.
Okay, just
Duncan,
let us know
really
when you're
need
going
to
to
have
buy
that
calls, and
intervention.
we'll do the anti-Duncan trade.
The anti-Duncan ETF.
Thanks to Callie for her inaugural appearance on the show. Callie, tell everyone where they can find your brand new newsletter.
Yeah, well, hey, I had a lot of fun on the show today. If you want to follow my work, obviously I'm on Twitter at Callie A. Bost. That's my handle. But I also have a newsletter. It comes out every Monday. It's called Optimistically, with the Callie at the end instead of Cally. And check me out on the Compound. I'm going to be on here more often.
Got it. Yep. Tune in to an all-new Compound and Friends on Friday. Yours truly may or may not be making an appearance. Wink, wink. Duncan, I'll see you in New York tomorrow. Thanks to everyone in the live chat for following along, everyone watching live on Twitter. Send us an email, askthecompoundshow@gmail.com. We always appreciate your questions, your comments, and we'll see you next time.
See you, everyone.
See ya.